Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study how they actually think. Today we're looking at a strategy called half-trend rail reversal. It's a trend-following expert advisor built around the half-trend rail, a noise-reduced trailing trend line made popular by Alex Orkhoff. In the next few minutes, you'll learn exactly how this rail decides when control of the market has handed over from sellers to buyers, or the other way around, and how the strategy turns that handover into a trade. Let's dig in. Remember, this is educational information only. So what does this expert advisor actually do? At its heart, half-trend rail reversal watches a single trailing line called the half-trend rail. Unlike a super trend, a chandelier stop, or a Donchian midline, which all trail a band of fixed distance off the average price or off a recent high and low, the half-trend rail works differently. It only flips its regime when the moving average of recent highs drops beneath a ratcheting anchor built from confirmed lows, or when the moving average of recent lows climbs above a ratcheting anchor built from confirmed highs. On top of that, each flip has to be confirmed by the closing price piercing the previous bar's low or high. That double gate is what makes the rail sticky. It deliberately ignores small, shallow wobbles and only turns when there is a genuine structural change in who is in control. Because of that stickiness, the flips of the rail tend to mark real trend changes rather than random chop. The strategy treats each flip as its trading signal. When the rail turns from down to up, it reads that as control handing over to the buyers, so it closes any short and opens a long. When the rail turns from up to down, it does the reverse. Importantly, only the transition bar trades. The strategy compares the rail's state bar by bar, so it enters once per regime change, not on every single bar of the trend. Risk is handled with the average true range, a common measure of volatility. The stop loss is placed a multiple of the average true range beyond the entry, and the take profit is set as a reward to risk multiple of that stop distance. This kind of approach is generally suited to traders who are studying trend-following systems on trending instruments, such as a major currency pair or a metal, on the hourly or 4-hour time frame. As always, trading carries real risk, and losses are part of the process. Let's walk through the logic step by step. On every newly closed bar, the strategy rebuilds the half-trend rail across its buffer of recent history. For each bar, it looks back over a small window set by the Amplitude parameter, which defaults to 2. Inside that window, it finds the highest high and the lowest low, and it also computes the simple moving average of the highs and the simple moving average of the lows. Those moving averages are the trigger lines, and the highs and lows feed 2 ratcheting anchors. Here's how a bullish flip is detected. While the rail is in a down regime, it keeps track of a minimum high anchor that steps lower and lower. The strategy signals a turn to up when the moving average of the lows climbs above that anchor and, crucially, the bar's close finishes above the previous bar's high. Both conditions must be true together. When they are, the regime flips to up and the anchor resets. A bearish flip is the mirror image. While the rail is up, it tracks a maximum low anchor. The strategy detects a turn to down when the moving average of the highs falls below that anchor and the close finishes below the previous bar's low. Now for the trades. The strategy reads the rail's regime on the just closed bar and on the bar before it. If the regime was down and is now up, that's a fresh bullish flip. The expert advisor closes any open short and, if it isn't already long, opens a long position. If the regime was up and is now down, that's a fresh bearish flip, so it closes any open long and opens a short. Because the state is compared bar to bar, it only fires on the transition, entering once per regime change. Risk management is entirely volatility-based. For a long, the stop loss sits below the entry by the stop multiplier times the average true range, which defaults to 2 times. The take profit is then placed above the entry at the reward ratio, defaulting to 2, multiplied by that stop distance. So the target is set to seek more than the trade risks. For a short, everything is flipped. The stop sits above entry and the target below. And notice that reversing on the opposite flip is itself a protective exit, since a new signal in the other direction closes the current position first. Let's read through the meta-editor code on screen. At the top are the input parameters. Amplitude, defaulting to 2, is the lookback for the high and low anchors and the moving average trigger lines. The ATR period drives the volatility measure used for stops. The stop multiplier and the reward ratio, both defaulting to 2, size the stop loss and the take profit. Then we have the lot size and the magic number that tags the strategy's own orders. Below that, 2 Boolean flags do the real work. The bull flip is true when the rails regime is up now, but was down on the previous bar. The bear flip is true when it's down now, but was up before. These are the fresh handovers. Look at the long block. When the bull flip fires, the code first closes any opposing shorts, and if it isn't already long, it reads the current ask price as the entry. The stop loss is the entry minus the stop multiplier times the average true range. It measures that distance as the risk, then sets the take profit at the entry plus the reward ratio times the risk. Finally, trade.by sends the order with that stop and target. The short block mirrors it exactly. On a bear flip, the code closes any opposing longs, then uses the bid as the entry. Here the stop loss sits above the entry. The risk is the stop minus the entry, and the take profit sits below at the reward ratio times that risk. Then trade.sell places the order. Both sides are symmetrical, and each carries its own volatility-based stop and target. Let's walk through this illustration candle by candle to see how the half-trend rail behaves. The blue line drawn over the candles is the rail itself. Notice how, on the left side of the chart, it sits above the price. That tells us the rail is in a down regime, and control belongs to the sellers. Look at the first few candles. Price is drifting lower, printing a series of gently falling closes, and the rail steps down above it like a ceiling. Each new bar's high stays capped, and the ratcheting anchor keeps sliding lower. There's no signal yet, because for a turn to up the strategy needs 2 things at once. The moving average of the lows has to climb above the anchor, and the close has to finish above the previous bar's high. Neither has happened, so the strategy simply waits. Now watch the fourth candle. Price opens near the recent low, then pushes up strongly and closes well above the previous bar's high. At the same moment, the moving average of the lows finally clears the anchor. Both conditions line up, and the rail flips. See how the blue line jumps from above the candles to below them? That's the down-to-up handover, and it's where the buy entry marker appears. The strategy closes any short and opens a long. Its stop loss is placed below the entry by a multiple of the average true range, structurally just beneath that fresh low, while the take profit is set at twice the risk above, because the reward ratio defaults to 2. From there the market trends. The 5th, 6th, and 7th candles print higher highs and higher lows, and the rail glides upward beneath them, acting as a rising floor and never retreating while the up regime holds. By the 8th candle, price has traveled the full distance to the take profit target, and the long trade closes for a reward of twice what it risked. That's the trend following idea in action. Enter on the confirmed flip, then let the move run. Now the picture changes at the top. On the 9th candle, price stalls and turns lower, closing back below the previous bar's low, while the moving average of the highs slips beneath the maximum low anchor. Both bearish conditions align, and the rail flips again, jumping from below the candles to above them. This is where the sell entry marker appears. The strategy treats this as control handing back to the sellers, so it opens a short. This time the stop loss sits above the entry by the average true range multiple, and the take profit is projected below at twice that distance. Follow the last few candles down. The 10th, 11th, and 12th bars each print lower, and the rail steps down above them as a descending ceiling, confirming the down regime is intact. By the final candle, price has reached the short trade's take profit target, and the position closes. Across both trades, notice the pattern. The strategy never tried to guess the turn early. It waited for the rail to genuinely flip, entered only on that transition bar, and let its volatility-based stop and reward-to-risk target manage the outcome. This is educational information only, and real markets will not always trend so cleanly. So that's the half-trend rail reversal expert advisor. We saw how the half-trend rail rebuilds itself bar by bar, how its double-gated flip aims to mark genuine handovers of control rather than shallow noise, and how the strategy trades each fresh flip with an average true range stop and a reward-to-risk target. We also read through the actual MetaTrader 5 code for both the long and the short side. Remember, everything here is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading involves real risk, and losses do happen. If you found this breakdown helpful, please like the video, subscribe for more strategy analyses, and leave a comment telling me which strategy to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.